Big developing story, front page of the Wall Street Journal this morning. New York Times has a big piece. It's all over the place. Another twist in the seemingly endless WeWork saga. New this morning, board members and early investors in the start are now pushing for the removal of its controversial co-founder and CEO Adam Neumann.
What if a company's entire, and I mean entire, $47 billion valuation could be destroyed by a single document? Not by a market crash, not by some new competitor, but by its own words, printed in black and white for the whole world to see. In 2019, WeWork felt like a global phenomenon. It was poised for one of the biggest IPOs in history. But when they were forced to reveal their secrets in a mandatory legal filing, it all came crashing down. Today on Corporate Forensics, we're not just going to talk about the story of WeWork's failure, we're going to read the very document that exposed it all. This is a deep dive into the S-1 filing that stopped the world's biggest IPO in its tracks and the powerful lessons it holds about the difference between vision and straight-up delusion. $47 billion. Just let that number sink in for a second. How does any company get to that kind of valuation? Well, back in early 2019, WeWork felt like way more than just a company. It felt like this unstoppable force, a revolution in how we even think about work.
But this giant had a fatal weakness. It was a story, a really good one, but it was built on some seriously shaky ground. And the whole myth got completely dismantled by just one thing: the S-1. That's the mandatory filing a company has to make before it can go public. And for us, this document, this is our crime scene. To understand how it all fell apart, first you got to understand the story they were telling.
So, Act 1, the myth. Before we start digging through the evidence, we have to understand the illusion. Because WeWork wasn't just selling office space, they were selling a story. It was what Professor Scott Galloway perfectly called a consensual hallucination, and pretty much everyone, investors, the media, you name it, they all bought into it.
You know, their official mission, right there in their legal filing, it wasn't something normal like to be the best in flexible office space. Nope, it was to elevate the world's consciousness. I mean, that's not business language. That's the language of a movement, a kind of spiritual calling. And it was all led by its super charismatic founder, Adam Neumann.
And that whole vision was tied completely to one person. Get this, the S-1 filing mentions Adam an incredible 169 times. 169! Just to give you some context, the average for founders, CEOs, and other big IPOs was around 25. Uber's CEO, he was mentioned just 29 times. This wasn't just a company, it was a cult of personality, and it was spelled out for everyone right there in the legal paperwork.
And this, right here, gets to the absolute core of the myth. WeWork sold the story that it was a tech company, a space-as-a-service platform. Why? Well, because tech companies get these insane, massive valuations. The reality? It was a lot more boring. It was a real estate company that rented desks. It was a global community in the story, but it was just an office subleasing business in practice. And this disconnect, this is the key to the whole collapse. Okay, Act 2, the autopsy. Now it's time to put on our forensic gloves. The S-1 filing is our main piece of evidence. This is where the story slammed into the harsh, legally required light of day. And the red flags, they weren't just there. They were everywhere.
Exhibit A, the dedication. This is the actual, literal opening line of their S-1. Not a financial summary, not an executive overview, this. Just imagine you're a Wall Street investor reading a legal document for a multi-billion-dollar IPO, and this is the very first thing you see. It was bizarre, it was cult-like, and it was a massive, immediate red flag.
Exhibit B, invented metrics. You know, when your real numbers don't look so good, what do? You just invent new ones. WeWork actually presented a metric they made up called community-adjusted EBITDA. This custom profitability measure was basically designed to look good by excluding fundamental costs of doing business. You know, little things like rent and construction.
Professor Galloway just put it perfectly. This wasn't some kind of creative accounting. It was a totally transparent attempt to hide enormous losses. It was, like he said, earnings before everything else. For any serious analyst, this was an absolute joke.
Exhibit C, the blatant conflicts of interest. Oh man, the S-1 was a treasure trove of self-dealing. Adam Neumann was both the tenant and, in some cases, the landlord, leasing his own properties back to the company. He cashed out $700 million of his stock right before asking public investors to buy in. But the most audacious example, that involved trademarking a single two-letter word.
$5.9 million.
That is how much Adam Neumann charged his own company for the rights to the word "we," a word he had personally trademarked. Just think about that for a second. He sold the company its own name. The public backlash was so bad that he eventually gave the money back, but the fact that it even happened in the first place was just a stunning display of terrible corporate governance.
So underneath all the weird language and the self-dealing, the core business model was just fundamentally broken. Think of it this way. WeWork was paying its bills with like a 15-year mortgage, but its income came from tenants who could just pack up and leave with 30 days notice. Their costs were fixed and long-term, but their revenue was flexible and totally short-term. I mean, that's an incredibly risky way to run a business. And this broken model led to an even more broken valuation. WeWork was asking investors to value it at 26 times its revenue. For some context, that's more than 6 times the multiple of Amazon, a real tech giant, and 26 times the multiple of its actual competitor, IWG. The valuation was just completely disconnected from any kind of financial reality.
So if we just boil this whole autopsy down to the 3 most shocking numbers, here they are. $47 billion in long-term lease obligations, basically a mountain of debt. $700 million that the founder took off the table before you could even buy a single share, and a 26x revenue multiple for a money-losing real estate company? It's just wow. All right, Act 3, the reckoning. When a story this big meets facts this harsh, the result is always the same, a sudden, brutal collapse. And once that S1 was out in public, the reckoning was fast. I mean, this timeline, it shows a crystal clear cause and effect. August 14th, the S1 goes public. The very next month, the IPO is dead. The valuation absolute craters by over 80%. That S1 didn't just raise questions, it was a kill switch for the company's momentum, and it led directly to its eventual bankruptcy.
The fallout was, in a word, total. The IPO was withdrawn in humiliation, Adam Neumann was forced out of the company he built, and that once unstoppable unicorn, now stripped of its myth and its access to all that cheap cash, eventually filed for Chapter 11. And what is WeWork today? Well, under new leadership after coming out of bankruptcy, they're now trying to market themselves as a grown-up real estate firm. So, in the end, they were forced to become the very thing they always insisted they weren't.
You know, the lesson here is incredibly powerful. Storytelling is absolutely essential in business. Vision is essential. But you cannot build a $47 billion company on a story alone. It has to be built on a foundation of sound financials, ethical governance, and a business model that, actually works. Which really just leaves us with a final, critical question for any founder or leader out there. At what point does a powerful vision cross that line and become a dangerous delusion? So what's the ultimate lesson from the WeWork S1? It's simple. Reality always wins. You can't just vibe your way to profitability. That dedication to the energy of we sounded inspiring, but the numbers, the conflicts of interest, and those bizarre metrics, they told a completely different story. And in the world of business, the numbers don't lie. This document is such a powerful reminder for any entrepreneur, leader, or investor. Your story must be built on a foundation of truth. If this forensic analysis gave you a new perspective on business, do me a favor and hit that like button and subscribe for more deep dives into the documents that shape our world. My question for you is, what company stories should we uncover next? Let me know in the comments below.